Wall Street just quietly changed the rules on AI stocks. Oracle and Broadcom didn't miss earnings. They just exposed the one question that can crater our portfolio if we're not paying enough attention. Look, if you're short on time or you'd rather not listen to some random cat guy on the internet, just know this. Finally, we are at a phase where the market's caring about AI demand and started caring about AI profitability. And if you're holding AI infrastructure plays, your thesis just got a stress test. Period. Alright, if you're still here, let me break down exactly what happened, why it matters, and what levels I'm watching in the next 10 minutes. Because this could be the beginning of something bigger as we enter 2026. So real quick, if you're new here, I'm DataCat. Former corporate slave, spent years as an analyst inside a Fortune 50 company, crunching numbers, building model pipelines, sitting through meetings that could have been one Slack message. You know how it goes. About 5 months ago, I traded the fluorescent lights for lasers and keyboards. Started this channel because I genuinely believe retail investors deserve more than the dramatic market headlines that are designed to confuse us. I'm not here to flex or pretend I've got some magic formula. I'm just an introvert who likes data, charts, and occasionally knocking things off tables. And if you are into this kind of things, please help smash that like and subscribe button for me so that my cat won't leave me. Anyway, let's get into what actually happened just now. Now, some of you may think that these are not some exciting companies, but Oracle and Broadcom together last week basically forced the entire market to ask a question it had been avoiding. Okay, AI demand is real, but how do you actually make money from it? You see, for the past 2 years, the AI trade has been like, demand is infinite, buy everything connected to it. GPUs, cloud, networking, data centers, just buy. While some of you might be sane and smart enough to ask the right question, the narrative was simply way too overwhelming and unstoppable to oversee common sense. And then, Oracle showed up with their earnings. And Oracle's numbers weren't even bad. Revenue came in at $14 billion and $6 million versus expectations of $14 billion, $210 million. That's a miss of roughly 1%. In normal times, nobody cares. But here's where it gets uncomfortable. Oracle's remaining performance obligations, basically their contracted backlog, exploded to $523 billion. Normally speaking, that's a massive demand signal. Bulls were probably thinking, great, the pipeline is enormous. But then the market saw something else. Oracle guided to $50 billion in capital expenditures for the full year, up from $35 billion just back in September, and their free cash flow for the quarter, negative $10 billion. Allow me to repeat, negative $10 billion. So the market did the math. You've got this giant backlog of future revenue, but you're burning cash today to build the infrastructure to fulfill it. Data centers, power systems, GPUs, all that spend is front-loaded. The revenue, that comes later, maybe much later. And here's the part that made institutional investors nervous. Oracle announced big new commitments from Meta and Nvidia as part of that backlog. Sounds great on paper. But some investors started wondering, are these truly independent customers? Or is this a kind of a circular arrangement again? Supplier buys from customer, customer commits to supplier. Even if it's all legitimate, and it probably is, that kind of opacity raises the discount rate. Investors get skeptical. And so they simply apply a higher risk premium. Oh, and Oracle also booked a $2.7 billion pre-tax gain from selling their Ampere stake. So when the EPS beat landed, some folks thought, wait, take that one-time profit out, how much of this is actually from the core business? The stock got hit. And more importantly, it gave permission for investors to start de-risking other AI infrastructure names. Think of it like this. Oracle was the cat that knocked the first glass off the counter. Didn't break anything critical, but everyone suddenly got very alert. And then, Broadcom reports, and honestly their numbers were solid. Revenue was over $18 billion, beat estimates. Adjusted EPS was $1.95, beat estimates again. AI chip sales up 74% year over year. They even guided AI chip revenue to $8.2 billion for the current quarter. By any normal standard, that's a great report. Stock dropped 11%. Why? One word, margins. Management explicitly warned that gross margins would compress on some AI systems because Broadcom has to buy more external components to build full server racks. They're not just selling chips anymore, they're selling systems. And apparently, systems have different economics than the market originally thought. So if you were valuing Broadcom as pure high-margin semiconductor play benefiting from AI, you suddenly had to recalculate. The mix is shifting. The margin profile is changing. And look, Broadcom also disclosed a $73 billion AI order backlog over the next 18 months. Demand is clearly there, but the market's question shifted from how big is AI to how profitable is AI and how smooth is the ramp. When a stock is up 75 to 80% year to date, even one margin caveat can trigger serious profit taking. Add in systematic hedging flows and options positioning into December expiration, and you get amplified moves. And so, Broadcom basically confirmed what Oracle started. The market is entering an AI accountability phase. Now, some of you might be thinking, wait, didn't we just get a rate cut? Shouldn't that be bullish for growth stocks? In theory, yes. Lower rates reduce discount rates, which should support higher valuations for long-duration assets like tech. But here's the thing. Equity risk premia can widen even when policy rates fall. If investors start worrying about payback periods stretching out, cash burn and leverage increasing, bottlenecks like power and construction delaying revenue conversion. And as I've previously pointed out, the rate cut didn't change the fundamental concern. Are these companies spending efficiently, and when do shareholders actually see returns? Also worth noting, on December 11th we saw rotation. The Dow and S&P held up better while the Nasdaq lagged. That's classic, sell the concentrated AI trade, rotate into defensives and cyclicals. The market wasn't panicking, it was repricing. So, let's now talk about technicals, because I know some of you are chart cats like me. QQQ on last Friday opened at 621.95, hit a high of 623.54, dropped to a low of 611.36, closed at 613.62. That's about a 1.9% down day. Frankly, that's quite a painful swing. But on the other hand, volume was only 0.8 times the 20-day average, and that tells me this was orderly de-risking, not forced liquidation. Sellers controlled the session, but there wasn't panic. Also, a quick trend context recap. The Golden Cross is still active. Both the 50-day and 200-day slopes are still positive. The higher time frame uptrend is intact, but, and this matters, the close is currently below the 20-day EMA and basically sitting right on the 50-day SMA. That's a decision zone. Meanwhile, RSI dropped from about 58 to 47.9 in one session. This signals a meaningful momentum reset. We went from trending to neutral very quickly. Now, for a more detailed breakdown, you could just go back to my last video. But in short, if QQQ reclaims and holds above 618, that's roughly the 20-day EMA. This resolves as a normal shakeout. If we lose 608, expect a deeper pullback into that 604 to 590 support range. So here's the question that comes natural. Is this a healthy correction or the start of something worse? Honestly, it can be both. On one hand, a market that punishes stocks for capex intensity, cash conversion issues, and margin compression, even while the demand narrative stays strong, that's a sign of discipline. Price discovery is working. Money is rotating, not fleeing. On the other hand, this is also the behavior you see when markets become more selective. Late in crowded trades, the goalposts shift from show me growth to show me ROI. Multiples can compress. Leadership can change. So, what would make me more confident this is just a healthy shakeout? Breadth improves, more stocks participating, not just the mega caps. Credit spreads stay calm. No stress bleeding into fixed income. Volatility stays contained. Sell-offs are orderly, bounces hold. And what would concern me? Good news sells off becomes persistent across multiple names. Rebounds fail quickly with lower highs. Support levels start breaking while defensive sectors lead. Right now, we're in the first camp, but I'm watching closely. So, that's what actually happened. Oracle and Broadcom didn't fail. They succeeded in ways that forced the market to grow up a little. AI demand is still real. But now investors want to see the math on profitability, payback periods, and cash conversion. If you're holding AI infrastructure names, this doesn't mean sell everything. It means understand your positions, know what you're paying for, and maybe don't chase things that are already up 80% without doing the work. That's the DataCat approach. Be curious, be skeptical, and always check under the couch cushions for hidden risks. If this helped you see the market a little more clearly, consider subscribing. I put out analysis like this regularly. No hype, no clickbait, just an introverted former analyst trying to be useful. Alright, thanks for watching. DataCat out, and I'll see you in the next one.